This video is part 3 of my series on lifting the veil of confusion about different order flow strategies. I'm someone who uses 3 different order flow concepts with some statistical helper levels to further make my trading pretty systematic. But before I go any further into micro order flow tools, you may have noticed that YouTube Shorts are stealing the spotlight over long form videos. I'm choosing to continue to make longer form videos because I think they provide a lot more context and value to you. Are we at risk of long form videos dying out in favor of TikTok style videos? Probably. So here's how you can toss me a lifeline. 1, hit like. It's free, it's easy, and it makes a huge difference for this channel. 2, click on subscribe, join my community for more ways on how to improve your trading pretty much immediately. And 3, drop a comment. Comments mean engagement for the YouTube algorithm. You got questions, you're confused, just want to say hi. Comments is where it's at. And yes, I actually do respond to all relevant questions. So if you do all this, couple of clicks here and there, you're giving us a fighting chance, and it doesn't cost anything, right? Okay, back to order flow part 3. I didn't get to my current skill level by starting on micro order flow. Quite the opposite. I started off as a swing trader who was immediately taught how to read institutional movement on larger time frames, which in turn taught me the value of a good trade location. Over the previous 16 years, I've conceptualized an entire method called the Market Stalkers method, aimed at traders who want to raise their skill level to professional status. And for any longevity in this business, you have to know your strategy to the core, be able to follow it, and you have to know yourself to the core as well. A good methodical approach can give you a reason and enough confidence to enter a trade that you've explained to yourself. And that goes a long way to get rid of most psychological issues that you might face. But if you start from micro order flow tools, it's kind of like trying to play the piano and starting on a piece such as The Flight of the Bumblebee instead of something like Chopsticks. It's not going to work. Why? Because for most people, your brain just doesn't have neural connections that will allow you to quickly and efficiently process the information that is assaulting you at the speed of light when you're trying to use these micro order flow tools. And this is why for anyone who is relatively new to trading, I would suggest starting out with something like supply and demand, or even just market profile. These are also order flow concepts. They relate to auction theory very heavily, but they are on larger time frames that slow everything down for you. And once you get the grips with those, eventually we can increase the tempo as if you were playing a musical instrument. And after a couple of years of practicing trading with those 2 methodical approaches, you can add a micro order flow tool such as Footprint and my personal favorite, BOOKMAP. So going back to the music analogy, think of using supply and demand like learning to play chopsticks on the piano, right? Technically not very difficult, but it takes some practice. However, generally, it's achievable in a relatively short time. In my methodology, I then move you on to market profile, which is kind of like Beethoven's for release. A little more challenging, more technical, and requires some speed of thinking. So you keep practicing with profile as you learn more pieces of the puzzle to recognize these setups and market state in real time. And maybe even to recognize when the setup is not playable, at least not with low risk, which is the entire point of being a trader, finding those opportunities that will help us to limit risk while offering a higher reward. Asymmetrical opportunities and good trade locations. So then once you're done with Beethoven's for release, aka market profile, we can take another stab at The Flight of the Bumblebee, BOOKMAP, time and sales, micro order flow. It is the same process. The neural networks and speed of thinking required to efficiently take advantage of something like BOOKMAP needs to be the final step in your progression as a trader, not the first step. Okay, we talked about sell zones and buy zones in the first video of this series when I talked about supply and demand. Well, BOOKMAP can offer you the zoomed in level of where the orders are as the day develops. One thing that I look for when I'm using BOOKMAP is any kind of stack of orders that are clearly visible. These can be spotted even on the regular ladder, the DOM. But here's the tricky part. Depending on the location of these stacked orders, they can mean the price might act as a magnet, so a draw towards liquidity, because stacked orders, just like supply and demand zones on larger time frames, represent a larger liquidity pool. And the reason why price is drawn to them is because institutional players need those in order to execute their very large orders at a lower cost of execution. This doesn't apply to us smaller traders who trade anywhere from 1 up to 100 contracts, because we don't have 3,000 and 5,000 orders of ES to fill for their clients. And we typically won't have an issue with entering the entire position all in one go, even if you're trading 10, 15, 20, 50 contracts. But the institutional traders, when they're filling their positions, they will sometimes take weeks to fill the entire client's order. One client, multi-million portfolio. And for such large orders, you cannot just fill them in one go. Why? Because if you look at the dome of ES, each price point only offers anywhere from like maybe 50 up to about 400 units on average. So you'll spend an age clicking buttons attempting to fill the entire, let's say, 3,000 contracts position. The clearing firms, the way they work, they also favor smaller orders over the larger orders. So you will get a faster fill. You will get ahead of the queue, so to speak, if you're trading 4 contracts than if you were to trade 50 contracts. Now, this is where the liquidity pools in the form of stacked orders come into consideration. Finding them will allow those larger traders to fill as many contracts in one go. This is also why those stacked orders act as magnets. Now, if the stacked order is seen quite close to the current price, like I'm going to show you here, it usually means that somebody wants to exit their existing orders. In this situation, the stacked orders are too close to the current price. So a reversal followed by an aggressive attack of the nearest opposing area is a good way to enter a momentum trade in the opposite direction. But if you have a directional move that has been going on for a while and you see some stacked orders further up or further down, depending on which direction we're moving in, these levels will act as your regular supply and demand areas, because that's where they are. This is what we mean when you hear Hogue on TopStep TV saying there's liquidity up there. Okay? That means there's a good chance the price will go to that level. Now, whether it reverses or smashes through it, that's an entirely different thing and a matter of context. Now, another way of using BOOKMAP is to spot larger orders coming in. So we have all of these bubbles, or bulls, as I like to call them. So when the bulls get bigger, typically you will see their effect on price, lifting the offers, causing the price to rise, or the opposite, hitting bids. It means the trader sells immediately at the bid. And usually, when you see this, typically there should be an effect on the price in the same direction. And of course, there are many other uses for BOOKMAP and other micro order flow tools, like spotting the absorption of orders. If you're seeing big bulls, but they're being gobbled up by the opposite side, then they're sort of disappearing, and they're not having any meaningful effect on the price either, that's when you see traders getting trapped and having to exit their positions. Now, to tie it all up with the market profile setup that I love, called the failed auction, when the price cannot break through an area, and you keep seeing an increase in volume and the big bulls coming in, but the price is not advancing further, this typically causes violent reversals pretty soon after, and then the continued momentum in the opposite direction. Now, obviously, there's quite a lot of discretion in these readings, which is exactly why you first need experience to read price at a slower pace, and why most new traders cannot see the forest for the trees if they default to BOOKMAP and footprint first. Context is everything in trading. To add insult to injury, there are behavioral quirks for each product that you're trading, so your ability to figure out the market narrative with other tools away from micro order flow becomes crucial. BOOKMAP bubbles can tell a story of the size of the orders at a level and the aggressiveness of participants at that level. And yes, once you've witnessed all of these 1,000 times, sweeps, absorption, iceberg, over time and with a lot of practice, you will be able to spot these much more clearly than the pure price charts. So this is why I've started using it quite a bit in my own decisions in sort of the last 3 or 4 years. But beware, if you're relatively new to trading, or you're new, but you're still not even remotely profitable or consistent, the likelihood that BOOKMAP events will scare you out of a perfectly good trade too early is very, very high, leading to low accuracy. Now, a lot of new traders also have negative risk reward. That's the recipe for disaster. So I wouldn't say that this is a tool for novice traders. In order for you to become consistently profitable, we really need those higher reward trades for the stability of your trading system over time. What do I mean by that? I mean that your trading system can remain profitable even if your accuracy falls below 50% and even 40%. But what I've seen over and over is that traders come to me for coaching with negative risk reward because they're only concentrating on tiny order flow events, and they're unable to sift through the ones that need to be given more weight over the ones that are just scalping opportunities. Hopefully this video will help you to delineate the differences and the confusion over why there's so many different order flow concepts. Each one of them has their use, but you need to be mindful of where you are in your skill level in order to realize whether this particular tool will be helpful to push your skills further or whether it's going to be a hindrance at this point of your development. This is why I also say let's strive to be less grasshopper and more market stalker. Now, if you haven't seen the other 2 videos in these mini series, check them out here.